Ponzi scheme investments. A Ponzi scheme is an investment fraud where returns to early investors are paid from the capital contributed by new investors, not from actual profit. The scheme relies on continuous increasing inflows of fresh capital to sustain the illusion of performance. Operators often use complex technical language like exclusive trading algorithms to obscure that no real profits exist. The scheme appears credible early on because initial participants are paid exactly as promised. Collapse is inevitable and occurs when redemption demands outpace new investments or regulators require asset verification. This unwinding exposes that principal funds were never invested, resulting in near total losses for late participants. The core lesson is that steady, high returns, lacking transparent, audited business activity, are synthetic and maintained by faith, not finance. Pyramid schemes and multi-level marketing. Pyramid schemes generate profit primarily through recruiting new members, whose entry fees finance the returns of those above them rather than selling genuine goods or services. The model is mathematically unsustainable and collapses once recruitment slows. Early entrants receive payments, creating visible success stories that attract more recruits. In reality, almost all revenue flows upward, and the vast majority of participants lose money. Multi-level marketing, MLM systems, imitate this structure by using tangible products to maintain a thin layer of legality. However, when revenue originates mainly from enrollment or internal product consumption and not external customers, the model is treated as a fraudulent pyramid scheme. The financial model is zero-sum, meaning only those at the top recover more than they spend. Economic gain depends on sustaining the belief in endless expansion, which always fails. Pump and dump market manipulation. A pump-and-dump scheme artificially inflates the price of a thinly traded asset, often a penny stock or cryptocurrency, using false or misleading statements. Organizers first acquire a large position at a negligible price. They then pump the asset using aggressive marketing, hype, and fabricated reports to create the illusion of rising momentum. Retail investors, seeing the surge, rush to buy, pushing prices higher, which allows the original promoters to dump or sell their holdings at the peak. Once the promoters liquidate, prices collapse, leaving late entrants with nearly worthless assets. Digital communication has supercharged this tactic, especially in minimally regulated crypto markets. The manipulation replaces natural price discovery with theatre. A key sign is sudden hype, disconnected from measurable fundamentals. Offshore shell companies and tax haven investments. Offshore shell companies are legal entities created in low-tax jurisdictions to hold assets or root income, often obscuring the true owners. The investment pitch focuses on optimizing global taxation and protecting capital from political risk. In practice, they often serve as conduits for undeclared wealth or insider transfers. The arrangement moves money through intercompany loans or fees, creating tax-deductible expenses in high-tax countries and taxable profits where rates are near zero. This gives the appearance of legitimate commerce. For investors, they offer privacy and asset protection, but they also facilitate tax evasion and sanctions circumvention. The risk is high. Jurisdictions may suddenly cooperate with investigators, freezing accounts, and a single misstep converts tax avoidance into tax evasion. Money laundering via legitimate ventures. Money laundering through legitimate ventures disguises illicit proceeds as lawful business profits by channeling them into enterprises like restaurants, car dealerships, or real estate. The high turnover and variable margins of these industries make financial irregularities difficult to detect. The process involves placing dirty money into the business, layering it through normal transactions, invoices, payroll, and integrating the profits as declared income. This makes the venture indistinguishable from a thriving enterprise on the surface. The danger is that the venture relies on deception, not demand. An audit exposing the discrepancy between recorded revenue and real trade activity can trigger asset seizures and tax fraud investigations. Warning signs include unusually rapid growth, excessive cash deposits, or a reluctance to seek external loans despite aggressive expansion. Hawala and underground banking networks. Hawala and similar informal banking networks are transfer systems built on trust, community ties, and off-book ledger balancing, rather than formal bank-to-bank settlement. They are pitched as a fast, low-cost way to move value across borders, offering access to liquidity in remote markets. The system relies on a web of intermediaries, hawaladars, who accept cash in one location and instruct a counterpart to pay a recipient elsewhere, often without physical or electronic transfer. The selling point for investors is the service yield from small spreads and quick conversion. However, the risks are substantial. Regulators treat unlicensed transfers as potential money laundering channels. Counterparty risk is concentrated, and the lack of pricing transparency can hide significant erosion of returns. Red flags include insistence on cash-only settlement and refusal of any audit or written receipts. Usurious lending and loan sharking. Usurious lending, or loan sharking, involves high-interest, unregulated lending arrangements where returns are generated from the borrower's inability to repay on time. Investors are attracted by exceptionally high yields, sometimes exceeding triple-digit annualized rates. The loans appear short-term, but repayment schedules are structured to make default almost inevitable, locking borrowers into continuous renewal cycles. The investor's profit derives from this dependency. This lending is often tied to criminal networks that enforce repayment through coercion. Even when technically legal, rates exceeding statutory caps or using hidden service fees constitute usury. Returns seem stable until regulatory crackdowns or borrower collapse expose the revenue base's fragility. The ethical and legal exposure means criminal prosecution can erase years of gains overnight. Drug trafficking investment partnerships. Drug trafficking investment partnerships finance contraband shipments, portraying them as high-margin projects with defined payoff curves. Financiers provide seed money for cultivation, transport, and bribery budgets, receiving a proportional share of the proceeds upon a successful consignment landing. The investment is essentially deal-by-deal project finance with extraordinary markups justified by prohibition premiums. Capital is segmented. One group funds production, another logistics, and another distribution. Documents are informal, relying on trust and control of violence rather than contracts. The risk is binary. A successful route can deliver multiples in weeks, but a seizure zeroes the position instantly. The high apparent internal rate of return, IRR, compensates for existential risks like arrest, interdiction, or betrayal. Profits are typically laundered, adding timing and haircut fee risks. Arms trafficking and conflict commodity funding. Arms trafficking and conflict commodity funding are pitched as high-return project finance, where capital is provided to acquire logistics or extraction capacity in volatile regions. The investment story emphasizes scarcity and monopoly pricing, as wartime demand or embargoed markets can produce enormous quick margins. The deals resemble project financing with fast cycles, where capital funds discrete missions and payoffs are realized upon sale. Returns are framed as compensation for the conflict premium of operating where others will not. However, the risk is extreme and multidimensional. Legal exposure can trigger criminal prosecution and international sanctions. Operational risks include interception, and financial risk involves sudden price collapses. The returns exist only while enforcement and transparency gaps remain. Human trafficking and smuggling networks. Human trafficking and smuggling are presented as repeatable cash flow businesses to backers. Capital funds recruitment, transport, housing, and forge documents in exchange for a share of fees or ongoing earnings. Smuggling focuses on transit fees, while trafficking seeks continuing revenue by coercing labor or sexual exploitation. Upfront funds, buy or lease vehicles, safe houses and pay bribes. Backers expect continuing returns through inflating victims' debts to maintain control. Risk is extreme and multidimensional. Routes can collapse due to patrols, and every link triggers severe criminal liability and asset forfeiture. The revenue stream is fragile, as seizures or victim rescues instantly sever cash flow and expose ledgers. The promised yields are merely the monetization of control. Removing that control collapses the returns and leaves criminal liability. Maritime piracy ventures, pirate stock exchanges. Maritime piracy ventures operate as investment syndicates, primarily off the Horn of Africa, where they have evolved into organized enterprises. Investors, who can be local businessmen or diaspora financiers, supply seed capital for boats, weapons and crews. In return, they receive a share of ransom payments or stolen cargo from a successful operation. The model is sometimes publicly tracked in informal stock exchange ledgers, with returns distributed by contribution tiers. A successful hijacking can yield multiples on capital in weeks. The economics depend entirely on coercion and instability in poorly governed waters. Once naval patrols intensify, success rates collapse, and the probability-adjusted return quickly turns negative. Risk exposure is total, including prosecution under universal jurisdiction and asset seizure. Dark web marketplaces and crypto-anonymity ventures. Dark web marketplaces and crypto-anonymity ventures are pitched as decentralized trading hubs for anonymous commerce, including narcotics, stolen data, and illegal services. The investment logic highlights massive transaction volumes and recurring revenue from commissions, operating where regulation cannot reach. Investors fund the marketplace itself, security escrow, or the financial infrastructure, mixers, privacy wallets. Early backers receive transaction fees or tokenized ownership, mimicking tech startups. The core value proposition, however, is opacity, with profitability scaling with the system's ability to hide users and operators. Transactions use cryptocurrencies for pseudonymity and escrow smart contracts to automate payments. Risk is high, with sudden platform shutdowns, cyber attacks, or government infiltration able to erase revenue overnight. The model monetizes secrecy, fees for hiding value rather than creating it. Cybercrime and ransomware as a service. Cybercrime investment networks, particularly those built around ransomware as a service, RAAS, represent the digitized evolution of illicit private equity. Investors finance the development, distribution, or hosting of malware in exchange for a cut of ransom payments. The domain of individual hackers has matured into a franchise model where developers supply tools, affiliates execute attacks, and investors fund infrastructure like servers and encryption frameworks. The financial case mirrors legitimate software as a service, promising scalable subscriptions, recurring revenue, and outsourced operations. Gambling, syndicates, and match-fixing schemes. Gambling syndicates and match-fixing schemes are presented to investors as predictive analytics ventures that deliver consistent returns by exploiting informational advantages. The core promise is reliability. Syndicate insiders allegedly know results in advance or can influence them directly, transforming chance into controlled profit. The structure has multiple layers. Financiers supply betting capital, coordinators manage accounts, and fixers, players, referees ensure predetermined outcomes. Profits are split proportionally after each event, with backers often reinvesting to compound returns. Some groups use pseudo-statistical reports to mimic the professionalism of legitimate trading funds. Art and antiquities. Trafficking. Art and antiquities. Trafficking is framed to financiers as a niche, prestige-laden alternative investment. The appeal is similar to legitimate art investing, scarcity and aesthetic value, but with the added layer of artifacts sourced illicitly from conflict zones or illegal digs. These can be acquired cheaply and sold at immense markups once cleaned through falsified provenance. The business model involves layered intermediaries. Smugglers extract artifacts, middlemen move them with falsified paperwork, and dealers insert them into the formal economy. Investors provide liquidity, funding excavation, shipping or storage, in exchange for a share of resale proceeds. Wildlife and timber trafficking. Wildlife and timber trafficking is an investment strategy where returns are derived from the high profits of trading highly restricted, often endangered species or illegally logged timber. Investors underwrite equipment, fuel, storage, and customs bribes, claiming a proportional share of each successful shipment. Proceeds are sometimes laundered through front companies like timber exporters or exotic pet breeders to blend legal and illegal revenue streams. The returns rely on the paradox of enforcement. The harder a resource is to obtain, the higher its price and the more profitable each shipment. However, this artificial scarcity makes the business unstable. Routes shift constantly, and enforcement campaigns can wipe out inventory overnight. Legal exposure includes trafficking and environmental crime statutes carrying multi-year sentences and asset seizures. Fraudulent life, insurance and viatical settlements. Fraudulent life insurance and viatical settlements are presented as predictable high-yield investments based on life expectancy models. However, corrupt operators falsify medical records, forge death certificates, or sell policies multiple times. Some recruit brokers to coerce or mislead the vulnerable into signing away coverage, or policies are taken out through identity theft. When regulators intervene, funds collapse as insurers deny claims and lawsuits proliferate. The ethical flaw is structural. The investor's profit depends on the insured's death occurring on schedule, creating an incentive to predict or influence mortality. Warning signs include secrecy around policy sources and unusually high promised returns.